Bitcoin treasury companies are essentially executing a speculative attack on the fiat system. They are currently arbitraging the mispriced financial markets, and they are accelerating Bitcoin's adoption in capital markets at the same time.
Are you all in on the chair? How many chairs are you sitting on right now?
Hello, everyone, and welcome to a short episode of One Chair podcast. Today, we're going to revisit the core fundamentals that underpin the Bitcoin Treasury Company Playbook. Let's start by looking at the types of Bitcoin treasuries. Bitcoin treasury strategies can be thought in two categories. The first one is straightforward, standard Bitcoin allocation. This is a partial or complete allocation of the treasury into Bitcoin. So in this case, companies convert part or all of their treasury into Bitcoin. Think of Tesla or GameStop. The second is the Bitcoin Treasury Company, or sometimes also called Leveraged Bitcoin Entity, or LBE, which is a continuous accumulation strategy involving the companies borrowing funds or issuing equity to purchase additional Bitcoin. Examples here include Strategy or Metaplanet. Here, it's important to note that not all Bitcoin treasury companies actually employ financial leverage. Here, leverage simply refers to the use of the company's balance sheet to acquire Bitcoin. In order to understand how Bitcoin treasury companies work, let's use Michael Saylor's analogy of the oil refinery. So we start here with the raw material, crude oil, which is refined at the refinery to be converted into various final products, such as jet fuel, diesel, kerosene, and many other types of products. Now, if we take Bitcoin as the raw material, by analogy, the refinery is the company's balance sheet. This allows Bitcoin to be packaged into the company's common equity, preferred equity, senior notes, convertible bonds, and other financial products. In the end, this is pure financial engineering. Now, before we go deeper on how this financial engineering is possible, we need to visit a couple of concepts. The first one is the mNAV, or multiple of net asset value. This is a valuation method, and the formula is enterprise value divided by Bitcoin NAV, where the enterprise value is equal to the market capitalization plus the debt minus the cash. Bitcoin NAV is equal to Bitcoin holdings times Bitcoin price. If the mNAV is above 1, that means that shares trade at a premium. If the mNAV is below 1, shares trade at a discount. The mNAV is sentiment-driven, meaning that in times of euphoria, Bitcoin Treasury Company mNAVs will surge, and in times of uncertainty, the mNAVs will be compressed. However, it also serves as a forward-looking metric, similar to discounted cash flow valuations, since leverage and share issuance indicate a company's potential for future Bitcoin accumulation. It's worth noting that a high mNAV can signal over-leverage, so beware. It does not only signal strength. The second concept that we need to have a look at here is the ATM, or at-the-market offering. An ATM is a type of equity issuance in which a publicly traded company sells newly issued shares directly into the open market at the current market prices to raise cash. With mNAV above 1, this is accretive. Each new share issued lets the company buy Bitcoin and increase Bitcoin per share for existing and new shareholders. Let's have a look at a brief example using Strategy. Strategy, ticker MSTR, has 1,000 shares outstanding, trading at $100 per share, resulting in a market capitalization of $100,000. Strategy holds 0.25 Bitcoin, valued at $25,000, with Bitcoin prices at $100,000. This implies an mNAV of 4. Current Bitcoin per share is equal to 0.00025 Bitcoin. Strategy issues an additional 1,000 shares at $100 each, raising $100,000. That way it acquires 1 Bitcoin. The total outstanding shares increases to 2,000, and total Bitcoin holdings rises to 1.25 Bitcoin. That means that the new Bitcoin per share is equal to 0.000625 Bitcoin. That means that the final Bitcoin per share is higher than the initial Bitcoin per share, and the offering resulted in a 2.5x increase in Bitcoin per share. So this way to generate more Bitcoin per share creates a flywheel effect, where companies weaponize their balance sheet to accumulate Bitcoin faster. So now let's have a look from a theoretical perspective at this flywheel, or the infamous infinite money glitch as some have come to call it. So Strategy issues shares with the ATM to raise cash. With that cash they buy Bitcoin, and that lowers their leverage ratio. This means that they can issue more leverage instruments such as converts, senior notes, or preferreds, and with that they raise more cash to buy even more Bitcoin. This increases the share price, and with that they're able to repeat the cycle over and over. This works best in times of bullish sentiment, but it is harder in bearish times, although it is still viable. Let's close with the key takeaways. Bitcoin treasury companies use their balance sheet and financial engineering with credit or equity instruments issuances to continuously increase their Bitcoin holdings. Metrics like mNAV and Bitcoin per share help assess whether this strategy benefits shareholders. Bitcoin treasury companies are essentially executing a speculative attack on the fiat system. They are currently arbitraging the mispriced financial markets, and they are accelerating Bitcoin's adoption in capital markets at the same time. Of course, none of what you heard is financial advice. It's only for entertainment and educational purposes. Thank you all for listening, and see you on the next one. Cheers.
How many chairs are you sitting on right now?